Hello and welcome to the Al-Attiyah Foundation podcast. My name is Stephen Cole. Today, I'm delighted to be joined by Ms Vandana Hari. Ms Vandana has 28 years of experience providing intelligence on the global oil and gas markets to executives in the industry and related services, government officials and agencies, as well as wealth managers. Before launching Vanda Insights in September 2016, Vandana served as Asia Editorial Director at S&P Global Platts, a leading information provider on the global energy, petrochemicals, metals, and agricultural markets. So, a very warm welcome, Vandana.
Thank you very much for having me. My pleasure, Stephen.
Not at all. Let's start controversially, shall we? Possibly. India is a major importer of Russian oil and is said to be taking great advantage of Russian, in quotes, distressed discounts. What is the mindset of Indian importers?
So it's quite simple, Stephen. It is purely based on economics. So if Russian crude is available for a discount compared to what it would have been pre-Western sanctions, if it is competitive as a result with comparable crude grades for Indian refiners, they will absolutely buy it. It's as simple as that. As long as they're not breaking any rules, which they aren't, we must remember, it's important to bear in mind that the Western sanctions do not prohibit anyone from buying Russian oil. They actually do not even prohibit anyone from buying Russian crude above the cap. That's a very important nuance that we could go into a little bit later. But that is, hopefully, that gives you an idea of how the Indian refiners are approaching this.
Indeed. Is India, though, breaking the $60 a barrel sanction limit? And will it do so if crude prices go up, if they rise?
Okay, so first of all, it's another important fact to bear in mind is that Indian refiners are not directly buying from Russia or from traders or from Russian crude producers. They are buying from intermediaries. So when an intermediary sells to India, the cargoes are being sold on a delivered basis. So the price that the Indian refiner pays includes not just the cost of the cargo, but also freight and insurance costs. So technically, the Indian refiner would not know when they're agreeing to a price in a transaction. They would not know what the FOB price is or what is the price of the crude on Russian shores. And that's the price that needs to be $60 a barrel. Now, you might say that, well, that's a technicality. And of course, the Indian refiner has to have some idea of what level it translates to on an FOB basis. And I wouldn't argue with you on that. But again, the second very important nuance to bear in mind is that the $60 per barrel price cap is only applicable if the trade is using Western services. So Western shipping, Western insurance, or Western other trade services such as trade finance. Now, again, as far as the Indian refiners are concerned, they are buying on a delivered basis. So the party that sold it to them and delivering the crude on Indian shores takes care of insurance, shipping, and so on. So it's not really the Indian refiners' lookout as to whether the price is, the FOB price is above or below the cap.
And what about payments, Vandana? Are they complicated to arrange outside the West's regulatory net?
So again, there wasn't a regulatory net as such as long as the transactions were being done below the $60 cap, which was the case for the most part of this year. But otherwise, yes, I think we have seen a shift in payments being made in UAE dirhams, for instance. There was some talk of being done in rupees, but I think that didn't really catch on. There was some demand from a request from Russia for Indian refiners to pay in yuan, but I think India is not too pleased about that option either. So there has some trade has been transacted, or the payment has been made in dirhams. But again, bearing in mind that there's really no US sanctions as such that is prompting this kind of, an alternate currency payment, but simply it's a case of Indian banks wanting to be extra cautious about let's say, the long arm of US sanctions.
Yeah, which is completely understandable. It's also been claimed there is a limit above which the South Asian countries won't pay for crude and refined products. Is that true? And if so, what sets the limits?
So I'm not sure where you have come across this information. There is no line in sand. Every country, every refiner, or a company that is buying a refined product makes a decision on a cargo by cargo basis based on what is their potential, how much they can, what sort of price they like, how it compares with competitive grades or competitive cargoes available in the market. If the prices is higher, when the markets are rallying, then will they be able to pass on the costs to their end users and so on. But what I would say in general is that in Asia, most of the emerging economies here are quite price sensitive. So when crude prices, refined product prices go higher, then let's say, let's call it crude above $80 a barrel, certainly above 90 and higher, it does, of course, they'll continue to use oil, but it does start showing up in their demand and demand growth. So you do see a demand response to higher prices, much more so in the emerging market economies of this part of the world, compared to, let's say, what you would see in Europe or the US.
And do the same arguments or your same answer apply to gas imports too?
I think more so for gas imports. So, oil is a far more fundamental energy source for these economies. Gas, of course, they've been using gas for almost as long, but the demand for gas has been growing exponentially more recently. So it's a relatively new input, shall we say, into these economies. And they do have, I would say, probably more price sensitivity when it comes to gas. So sort of a rule of thumb, especially when it comes to major gas consumers and LNG importers in this part of the world, like China and India, is $10 per MMBTU. Prices above that make buyers very, very cautious. Levels above that also start to dry up incremental demand. So what you're left with is pretty much base load demand. The few industries, the fertilizer sector, which is heavily subsidized by the government in India, which can still afford to pay. But at that anything beyond $10 per MMBTU is where you're then just left with base load demand, and it starts to shrink demand growth pretty fast.
Well, that's very clear. Crude oil production, Vandana, in the Asia-Pacific region is falling, with Brunei, India, Indonesia, Malaysia, Vietnam all showing significant production drops. What do you think is causing that? Is there a general lack of investment?
It's a confluence of factors, Stephen. So a few things to bear in mind here is that a lot of these countries that you've just named have been producing oil and even gas for decades. So that in effect means that they are sitting on very old reservoirs. Now, old reservoirs obviously means they are depleted. Yes, sometimes you can coax the marginal barrel out of them, but you typically need very cost intensive enhanced oil recovery or EOR techniques, which, in this day and age, especially looking out into next 10, 20 years, companies are not very sure if they'll be able to recover those kind of costs. And of course, EOR techniques are not applicable in every reservoir. So one of the main problems has been aging reservoirs, but also no new discoveries, no major new discoveries have been made in this region. Now, if you ask me why, it's probably just goes down to basic geology. You know, whatever oil or easy to find oil was there, was found, 30, 40, 50 years ago, and it's already been tapped. Now, I think we would be remiss if we didn't mention that the exodus of global oil majors and other independent players in this part of the world has also played a role. As we've seen in the past few years, as these companies, the oil majors have pivoted, they want to move away from fossil fuels. At the very least, they don't want to continue putting more money into, let's say, older fields and projects that have already are at the end of their life. That has left a lot of these countries in this region basically looking to their national oil companies to pick up the slack. Now, to their credit, a lot of the national oil companies have done so, but you can't suddenly expect them overnight to have the technology, the deep pockets, the other expertise, the manpower expertise that their overseas partners had, and which was deployed in these countries over the years. So that is the overall scene. There isn't, unfortunately, much sort of light at the end of the tunnel for these countries. They have to do the best to manage their existing reservoirs, and wherever possible, try and use enhanced oil recovery to tap as much oil as is still left in them.
Yeah, I completely understand. Certainly, after the perhaps easier access has moved on. But you've recently commented in your excellent Vanda Insight series, the volatility within oil markets raises more questions than answers. Can you update us on market volatility? Is it any clearer which direction the markets are going to go now?
No, unfortunately, Stephen. It looks like we're just getting into an era of more and more complicated, complex markets. Just the sheer number of forces and the diversity of forces that are acting upon the oil markets and oil prices continues to rise. So again, just to take a few examples, of course, we'll not hark back all the way to COVID, though that was a major shock for all markets, the world, but certainly so for oil markets. The kind of demand destruction shock that oil markets had never seen for as long as they've been around. But more recently, of course, we've seen the Ukraine invasion, what followed, the huge fear over losing Russian oil supplies, in nearly 10% of oil supplies. So that rattled markets, and then just we've had one event after another somehow whiplashing oil markets. Just doesn't seem to stop.
It's incredible, isn't it?
Yeah, and right up till the Hamas Israel-Hamas conflict from a few weeks ago. So geopolitical risks, geopolitical issues have become major. And on top of that now, because of all the economic uncertainty, because of this big shift that we are seeing in just central banks going from a long period of easy money to tightening, to borrowing costs being the highest in over 2 decades, all the economic and financial market uncertainty that it is causing. The problem for the oil markets is that it's very hard to connect all the dots from whatever we are observing in macroeconomics with what it will translate to in terms of oil demand. So what does end up happening is that the economic sentiment, which you see reflected in your usual risk assets on a day-to-day basis in the market, gets used as a proxy for oil demand. But because it's a proxy, and because there's so many other dots to connect between, what let's say the PMI, manufacturing going up or down, retail sales, consumer sentiment going up or down, and what does it translate to in terms of oil demand? Because of that, you end up having a lot of basically you're shooting in the dark.
Yes.
A lot of speculation happens as well, which also muddies the waters. So it's a very, very challenging time.
Yeah, muddying the waters, exactly. You mentioned Russia-Ukraine conflict, which has caused quite a few issues, including gas supply to Europe. As we're coming into winter in Europe, occasionally European gas buyers outbid Asian buyers for supplies. Is the gas supply between East and West roughly in balance now, with only occasional arbitrage windows opening?
So for the time being, the gas markets are breathing a bit easy. Europe has managed to stock up quite a bit in terms of gas stockpiles, which it needs to be ready for the higher demand in the winter season. As of now, I understand they are the storages are 97% full. So that's good. And also there's been a contraction, a structural drop in gas demand in Europe. So all of that, there is also an interaction between diesel and natural gas, because typically if Europe runs very short on natural gas, it tends to, wherever it can, it tends to switch to diesel. But so diesel and gas, there was an interplay between these two over the past several weeks as well, especially when Russia banned diesel exports just out of the blue. So that has eased as well now, since Russia is back in the market with its diesel exports. So all said and done.
So beginning, sorry to interrupt, but beginning to settle.
For this winter, I would say, for 23-24.
See, well, the thing is, speculate any further.
You can't.
The next few months,
and
can you?
Exactly. And even for the coming winter, if you have a worse, a colder winter than is expected, you may have a problem again in the gas markets.
Okay. Just a quickie, and I'm going off piste here. How does the Asia-Pacific region view the climate change actions from certain countries, mainly Western countries? Is it perceived as a rich man's problem? And briefly, if you will.
I wouldn't necessarily categorize it as a rich man's problem, but some of the demands that are being made in terms of Asian economies setting stricter standards, stricter goals for emissions, discarding the use of fossil fuels, especially coal, on which the economies are very dependent, and price sensitive, and economies. I think that's probably seen as very unfair. So all that it's not about rich man, poor man. It's about them saying that, look, energy security, sustainability, stability of supply, accessibility, and affordability. These are important for us. So we need to have a way to chart our own pathway to decarbonization.
All right, that's very fair. And moving to China, when do you think, that China's economy sort of not bursting aflame at the moment? It's ticking along very nicely, but not as strong as before COVID. But when do you think the demand for fuels in the Middle Kingdom will rise again?
So it is growing. Even this year, it has been higher than last year. Of course, the last 2 years particularly were pretty dampening for Chinese energy demand overall, not just oil. Will it? I think the important question for the oil markets is, will it ever go to high single-digit year-on-year growth rates, or even double digits that we've seen at the beginning of the century, for instance? Never. I can almost say that with certainty.
I think that's fair. That's not speculation. That's very accurate, I think. Well, can you summarize the situation with regards to gas supply in China? I'm thinking of any updates on the Power of Siberia 2 gas pipeline that will export the natural gas from Russia's Western Siberia Altai region to northeast China. Any updates there?
Yeah, so Chinese gas demand is growing, but I would say at a moderate pace. Gas accounted for about 9% of China's energy mix in 22. The share is expected to rise to about 12% by 2030. But again, mind you, that's part of a growing pie as well, right? It's interesting, the Power of Siberia 2 gas pipeline, the talks have been going on for years. But obviously, the tables have turned quite dramatically since the Ukraine war, and since Russia does not have the same outlet for its gas in Europe that it used to have. So we're talking here of a pipeline to carry 50 billion cubic meters of natural gas from the Yamal region into China via Mongolia. It'll be a substantial amount of gas for China. China should want it for sure, especially because there is every chance that China is able to get this gas way cheaper than even the Power of Siberia 1 gas pipeline prices, definitely way cheaper than LNG, and potentially cheaper than other pipeline gas that China gets from some of the other Central Asian countries. So it is in China's interest, but look, it's as simple as this. That China is in a much stronger bargaining position vis-a-vis Russia now. So Russia needs China far more badly than the other way around. So what I understand
is almost like a junior partner relationship, isn't it?
Exactly. So what I understand is that the state-owned CNPC in China is driving a hard bargain on prices. So we may see it happening. There was some expectation that it would be announced when Putin visited Beijing last month, but that did not happen. So from all accounts, it's probably stuck on prices and China trying to get a really good deal for itself.
Right. Lastly, Vandana, do you think the Asian countries will ever give up coal? China certainly seems or shows no sign of doing that, in spite of it being a high CO2 emitting generation fuel.
So they understand the implications of it. Let's make no mistake about that fact. But they also understand the perils of giving it up. I mean, you can't just give it. If your electricity generation, 40% or 60% of your electricity is coming from coal, you have to have an alternative that is affordable and accessible, so available basically, with secure stability of supply. And when such an alternative is available, for sure they'll give up coal. But these countries are very pragmatic. They keep their economic growth squarely in focus, and energy affordability and the other factors, as I mentioned, accessibility, all of these are important. So I think it will take a long time for these countries to completely give up coal. I think before that, we might see ways in which they try to abate emissions from coal at the power plants. We know that China is doing that in a big way already. But they can't let go of it without an obvious alternative.
That concludes our interview for today. Thank you so much, Vandana, for providing us with some great insights that I'm sure our listeners enjoyed. I certainly did. The Foundation looks forward very much to speaking to you again in the future. And thank you for listening. Be sure to keep up to date with all of the Al-Attiyah Foundation's work by following us on X, we used to know it as Twitter, and YouTube. You can find us under our name. So from Vandana Hari and me, Stephen Cole, goodbye.
Goodbye.